Welcome back to the channel. So in today's video, I'm going to show you why I only want to trade during the highest volume times of sessions and why those specific times give some of the best opportunities for our setups in the market. Because one thing that completely changed my trading was realizing this, that not all hours in markets are equal. So a lot of traders spend the entire day staring at charts, forcing setups during slow periods when price is barely even moving. And the whole point of trading is that you trade to live, not live to trade. And the real opportunities usually come during very specific windows of time when the volume enters the market. And once you understand that, trading becomes way more efficient. So let's break it down. Essentially, when I'm looking through the charts, one of the main things I'm trying to identify is this: where is the biggest candle of the session usually, typically, in history? Because most of the time the biggest candle tells us where the highest amount of volume entered the market, and volume is what creates movement. For example, during London session, if we look between around, let's say, 2 a.m. and 4 a.m. EST, we'll usually notice one candle that's significantly larger than everything around it. So that's a time period that we want to trade in. That candle matters to us, or them few candles, because it tells us, institutions stepped into the market, the hedge funds, the large money. It tells us there's a lot of money in the market. And that's the type of movement that we want to take advantage of. I'm not trying to sit in trade for hours if I don't need to. I'm not a swing trader, it's intraday. So I want the cleanest move in the shortest amount of time possible. And when I looked at my own statistics, most of my trades only last anywhere from about 2 minutes to maybe 10 or 15 minutes on average when I'm actually in the trade. Now why? Because I focus on them high volume periods. So London session is that 2 a.m. EST to kind of 4:30 EST. High volume creates the movement, and the movement creates opportunity. So New York is typically, for me, New York Stock Exchange, which is about 9:30. So I get on the desk for 9. Now during these high volume times, two important things usually happen. First, higher time frame wicks often get filled. And second, support and resistance levels get retested. That's why these sessions are so powerful for the way that we trade. So for example, let's say we have a 4-hour wick that still hasn't been filled yet. Then price pushes into a key support or resistance area during a high volume window. Let's say it's New York, so 9:30 Stock Exchange Open. That combination creates a much higher probability of an aggressive reaction, and those are the setups that we're looking for. They're not random entries. You're not chasing candles. You wait for it to align for you. I want confluence during the times where the market is actually moving, not consolidating. So the process becomes very simple. First, I identify the times where volume consistently enters the market. For me personally, a lot of those moves happen during London session, Stock Exchange Open, and New York Stock Exchange Open. So for London, that's kind of get to the desk at 2, finish at 4:30 Eastern Standard Time. And then for New York, get to the desk for around 9 a.m. Eastern Standard Time and finish at around 11 a.m. Eastern Standard Time. And then you have to ask yourself key questions. Is there a higher time frame wick that needs to be filled? Is there a playbook setup? Is there clean range? And if all those things align during high times of volume, that's another confluence. And that's where I enter with much more confidence because of the data that I've collected previously. Because I'm not trading based on emotions or hope. I'm trading based on data and repetition that I've collected over time and experience. And that's a huge difference. A lot of traders struggle because they try to force setups during dead hours. They'll sit at the desk all day. The market is barely even moving and you're trying to catch a trade. Volume's low and they're expecting, big reactions in conditions that simply don't support it or allow for it. But once you start focusing on only, on the periods where the market naturally moves the most, everything becomes a lot cleaner. Your execution improves, your patience improves, because trading is all about patience and discipline, and your trading becomes much more efficient overall, because at the end of the day, trading is a probability game, right? And high volume sessions help put those probabilities more in your favor. So why wouldn't we want another probability in our favor? So hopefully this video gave you a better understanding of why high volume times matter and how you can start using them in your own trading. So if you enjoyed this breakdown and want to see more videos like this, make sure to leave a like, subscribe, and let me know what you want me to cover in the next video. Appreciate you all for watching, and I'll see you in the next video.